Gas didn't just get expensive. It got personal, global, and political all in one.
Well, then what kicked this off? Because it didn't just happen overnight.
True. So let's rewind it back a little bit, because this all really started with obviously Iran conflict and all that sort of stuff. And people are wondering, if we produce so much oil, right, why, am I seeing it, shoot up so much at the pump and all that sort of stuff? That's the first indicator we notice is our gas prices, right, that we fill our vehicles up with right away. Well, what people don't realize, a lot of folks don't realize, is yes, we actually do produce a ton of oil. Domestically, I think the U.S. is actually the number one oil producer, I believe, in the world at this point. But 1/5 of the global oil actually flows through the Strait of Hormuz. So that strait is where all that constraint is with oil globally. So that's how we export. It's how other countries are able to get their oil. And keep in mind, oil prices is a global commodity, kind of like gold and silver is. So we're seeing the prices of oil get repriced in different countries, especially if they have a weaker dollar, which we can go into more in depth. But ultimately, we're seeing it because of the Iranian conflict. And then ultimately, it's about the Strait of Hormuz and being able to actually export oil and be able to move oil globally. So it's not about the production here. It's about how it actually affects the global economy within oil.
So is it due to supply restriction, or is it just an anticipation of volatility?
Yeah, so it's interesting. Usually when oil prices move, it's actually an anticipation. So typically prices are going to move first off of fear. So fear is usually the first thing that moves. That's why, you can see this conflict start, and overnight you see the gas is already risen at the pump before there's any kind of real supply constraints yet. The problem is the price moves before the actual constraints in the supply chain hits, right? So the longer this goes on, the longer that oil stays high, the more of a serious actual real impact it has on supply chains across the world. And it goes back to energy, different energy crises that can happen in different countries, especially, like I mentioned before, that have a weaker currency versus the dollar. It really, really impacts. So smaller countries actually get hit twice, and we can dive deeper into what that means. But first of all, it's fear-based, and then it goes into the supply chain base. And keep in mind, the world's economy essentially runs off of oil. So if, for example, you've got oil-producing nations, the United States obviously is one of them.
Sure. If we're producing enough oil, because I hear this all the time, we have enough oil for us for a very long time. It's not really even a shortage, right? So why are we getting this? And in fact, I've even heard, do we even get oil from Iran?
Yeah. So the key thing here to think about this again is that oil being a global commodity is priced globally. And that being said, when there is supply constraints across different countries and 1/5 of the oil, so you can think of that, what that means is when other countries can't get their oil, it becomes a lot more in demand. So what does that do to the price? It goes up, whether it's in the US or not. That's where we can use our strategic reserve to try to help out our own supply here, right? That kind of brings prices down because we flood the market with extra supply, but it gets repriced globally. So that's kind of the difference. So
do we essentially have to buy it from ourselves?
Or
promise to sell it at that rate.
It's more like promising to sell it is kind of what it is. The oil's futures market and all that stuff is pretty complicated, especially when you look at just such a different global scale with all different currencies and that sort of stuff, and it's very complex. But what I would say is when you think about the price of oil, it more is fear-based right now. So like I said, the oil futures are going to move before the actual supply chain constraints happen. The problem is if those oil futures stay high like they have been, that's when we actually start seeing real issues. That's when we see recessions, global recessions. That's where we see stock market crashes. That's where we see, all that sort of stuff, right? Because the prices move before the actual issues arise.
So it's based on a replacement cost.
It is, and it's also expected on future ability to actually be able to have that oil, right, and be able to meet all that demand. So because that's essentially what the futures, market is doing. It's basically pricing on probability, right? Probability that the oil is going to be able to meet demand, right? And then when 1/5 gets essentially cut off from the rest of the world, there's a huge issue. So
Well, right, because
it's basically saying 20% of the world's oil supply flows through the Strait of Hormuz.
What are some significant countries right now that are going to be restricted? I mean, I realize you may not have a list of those, but what would be some of the countries that are going to be immediately impacted by the fact, 20% of the world, which 20% is going to be impacted by this?
So obviously geography plays a huge part in this, but I would say the bigger part of all of this, interestingly enough, are the countries that have weaker currencies versus the dollar. So the ones that have weaker currencies are the ones that are going to be impacted the most.
Gotcha.
That's number one. Geographically, it matters, but then keep in mind, countries have their own reserves and that sort of stuff. But the currency factor is going to be a big problem because oil increases, our dollar gets stronger, right? And all the other countries' currencies a lot of the times typically get weaker, and so they're able to purchase less oil with their own currency.
Yep.
And the exchange rate,
the same amount of money buys less.
Exactly.
Right.
Yes. Yeah. Because the US dollar is the world's reserve currency and all that sort of stuff. And so you can see the dollar, I believe, was over 100, right, on its index, I believe yesterday, and so we were actually trending around 96 on the index. Now we're at 100. So it's gone up about 4%.
So, I mean, from one of the previous conversations that we had, Trevor, on Undeniable, as a matter of fact, you talked about a melting ice cube.
Yes.
So essentially, this is put a hot plate underneath that melting ice cube, and it's melting at a more rapid rate.
Yeah. Well, so that's always happening. So that's always going to be an issue. Just that's an inflation issue, and it's kind of how our financial system is really set up, debt based, right? Borrowing economy is how it really works out. But this is kind of like, I guess a good example is when the dollar gets stronger, it means other currencies basically get weaker, so they're able to purchase less. And so when they're able to purchase less, it means they're able to purchase less oil from us. Number one, they're able to purchase less oil, less goods and services, less everything. Right. And what does that do? We have less countries to export it to, less customers that way. Right. Because of that, because, obviously the demand isn't there, or at least the purchasing power isn't there. So when oil rises, dollar gets stronger, all these things happen. That's why you see, equity markets and that sort of thing go down. Right.
Well, what's the first thing people actually feel from that? I mean, so we've seen the prices go up, their dollars get weaker, our dollar gets stronger. How does that result? I mean, what's the first thing we feel? Obviously, the gas prices go up.
Yeah.
But what's kind of like step two after that kind of thing? Because the gas prices going up is really the rock, so to speak, right? I mean, it's part of the rock, I would say. You've got the conflict in Iran. Yeah. Which is obviously the big rock, but part of the rock as well is the immediate response to that we saw.
Yeah.
So, I mean, what is the first thing that people really see as a result of that rock hitting the water?
Okay, so first is gas pumps at you filling up your vehicle. Second is typically you're going to start seeing things in, like, let's say grocery stores and that sort of stuff like that, because that's when you're actually going to be hitting the supply chains, right? The cost goes extremely high to actually, all the logistics for these companies to be able to transport their goods and services, right? And that sort of stuff. So prices will usually start to become a little bit higher in stores and things like that because the cost to actually transport. There might even be less goods available as well due to that. These companies having to reposition and pivot and that sort of thing like that. And then ultimately prices rise. Demand might still be there, but the purchasing power isn't there. So they ultimately have to purchase less. That flows into earnings. After you see at the grocery store, prices are going to go up, volume drops, and then earnings comes out for these companies, right? And then that's when you can start seeing equity markets start dropping. But typically what's going to happen is those equities will drop before the earnings even happen because it's all forward looking.
Okay.
So it's kind of a double whammy in that sense. So yeah, so that's kind of what you're going to see next if this stays, right? It doesn't have to. So, but that's something to look for.
What are so obviously this is going to affect consumer behavior.
Yeah, definitely.
Right. And so, what are some of the things that you would anticipate consumer behavior? And if you are going to, instead of, I guess what I'm asking is if the consumer
Yeah.
wants to be responsive rather than reactive, right? There's nothing we can do about the price of gas as an individual sitting at home on our couch,
No.
right? On Main Street. There's nothing we can do about that. So, what is the reactive versus responsive kind of things that can help maybe cushion this a bit in the early onset?
Well, I mean, it depends on what you're trying to essentially hedge against, right? I mean, when it comes to purchasing and that sort of thing, especially if we do see goods increase, right? Well, I mean, I guess maybe a more private label, purchasing private label brands, right? Store brands, right, to help save money there, take advantage of coupons, all the things that people already know what to do. I would say when it comes to actually protecting like your financial picture, um, basically never being forced to exit your equity position at a time when you need the dollars and that position is down from where you need it to be. So setting up proper hedges, right? Having non-correlated assets all set up, right? So, the stock market goes down, okay, you've got an asset that's buffering that you can pull from, right? That is growing maybe slower, but it's less volatile.
It's heads. It's so
It's hedging against having to sell at a really bad time, but you need the dollars.
uh-huh.
So setting that up, if you don't already have it set up now, I would always suggest folks start looking at getting something set up for themselves to where they have multiple buckets of liquidity, right? And then they can pull from those buckets, right? When markets are doing well, they can pull from the market account. When the markets are doing poorly, they pull from obviously their buffer account or their hedge account.
Right.
So that's more like fixed interest.
Gotcha.
Right? And there's different ways to do it. There's different efficient ways to do it. We can get into the tax, all that sort of stuff. But again, ultimately, what you're doing is you're just protecting yourself against times when you don't know you're going to need the money. You don't know what's going to be going on a global macroeconomic scale, right? And all this is just driving a ton of uncertainty. So I would say just look at your time horizon too when it comes to your finances and that sort of stuff.
So this is obviously going to create some cost pressure on households, right? I mean, are we?
Yeah.
I mean, are we seeing? Are we already seeing fluctuations in the pricing index, or are we just sort of hearing just sort of the outcry and the outrage of the president that I picked isn't in office, and it's all his fault that the gas prices are high? Because I know that we often that's the first thing we do is we like to go blame some lack of policy on it.
Sure. I would say there's a lot of downstream issues that's going to come up, especially if oil stays elevated at these prices right now. I mean, of course, it's going to affect households in many different ways. It's going to affect our Fed policy too, more than likely. It's one of the levers that they've got, right? It could affect interest rates, right? Because with oil prices this high, and if they were to stay elevated this high, it puts extreme risk that we could go into a recession. And so you got to think about the ways that our government has the different abilities and levers they've got to be able to try to pull us out of recessions. So that's the other thing you want to think about. And so, I mean, I guess, does that answer your question?
Well, I mean, what I'm really it does answer, because what we're going to begin to see. I mean, I would assume that public frustration is about to happen, right? And
Yeah.
there's going to be a lot of opinion that gets thrown around on what the possible solutions are. Often there's just a lot of complaining, right? And what sort of public pressure and what sort of places where are they likely to kind of, other than maybe at the grocery store or something along those lines, where else does it impact other than just maybe day-to-day staples?
Well, I mean, it's gonna impact your energy costs too. It's gonna affect your electricity cost. It's gonna affect all that sort of stuff, right? It's gonna impact virtually everything that you have to pay for, right? Because, like I said before, the global economy runs on oil. And it doesn't just mean transportation, it also means production of goods and that sort of thing too. So ultimately, all you can do is you can just hedge as best possible against, different things like that. So that's really all you can really do.
So there's a lot that the United States can weather, You know what I mean? We can handle for a time, right? $4 a gallon.
Yeah.
You know, and that's just here in Texas, right? And Texas has well below the national average
sure.
typically, right? And we talked about this a little bit earlier. What is it likely to do on the day-to-day life of, you know, somebody who is relying on oil that is coming out of the Strait of Hormuz or is not coming out? Most specifically, the ones with the weaker dollar, but also the ones that aren't an oil producing company that don't have any strategic reserves or possibly like that. I mean, what is likely what are going to be some lifestyle changes that these other countries might see? Our lives go on like normal. It's just a little bit more painful. What is it likely to do to somebody that is not living in a strong economy like the United States?
Well, I mean, what could very possibly happen is they go into a recession in their own economy, and then the problem is the world has gotten so much more, I don't know what you want to call it. I mean, interconnected in the way that even our Fortune 500 companies work, right? And so the problem is you have these smaller countries that go into recessions, and that can impact U.S. companies' ability to export their goods and also services. And what does that do? If the U.S. companies can't export these goods and services to a lot of these other countries that are in recessions, well, it puts a lot of stress on them. And then ultimately they have to scale back what they're producing. And then to scale back their production, they've got to scale back their costs. And labor is a huge cost. And so what does that do? That's where you get huge layoffs.
Okay.
So it does affect us. So other countries' recessions absolutely impact us.
That's how it impacts us
absolutely.
Here. Yeah. So
absolutely,
I mean,
it matters. That's what they call it, the global economy.
Take the car industry, right?
Sure.
I mean, I know we don't export a lot of cars, not near as much as we import.
True.
But if gas prices are $13 a gallon, you know, in Australia or whatever the case may be, if it's $13 a gallon in Australia, right?
Yeah.
There may be restrictions on that, which means they're not going to even need to buy a new car.
No.
Should this persist.
Right.
Right.
Well, and then look what it does to, I mean, buying new cars, and then look what it does to the tourism industry across the world, right? What that would do. Cost of all those, you know, kinds of things go up. I mean, what would likely happen, and this typically happens a lot in recessions, right, is that all of a sudden, all of the luxury things, the leisure items, right, the vacations, they're all they're done. Like the tourism industry collapses. That's where you see, you know, entertainment industry gets hit really hard, right? People just don't have dollars for that sort of thing. Streaming services start getting canceled because people can't afford it, right? All these sort of things start happening.
And there's other social impact to this as well, as I would think, because people get depressed.
Oh yeah, I mean it's huge.
Right.
Oh
so
yeah,
so you see your
talk about the I mean impacting human
it could influence
emotions.
crime. I would say, you know what I mean?
Yeah, I mean think about it. Like people get laid off from their career. I mean that's huge. I mean that's especially you got a family, that sort of thing. I mean of course you're gonna have, you know, huge emotional impacts, huge socio-economic impacts. All these sort of things could be impacted. So that's the risk.
All because gas prices went up $1.
Right. Yeah, at the gas pump. And then exactly. And so the real risk isn't that it's high right now, although it is risk. The risk is that it stays elevated for a longer period of time.
How long can we handle this? I mean, what do you think economically? And I know that is a wild guess.
Yeah.
I mean, I'm just drawn on what is your gut hot take on that?
I would say, I don't know for sure, but I would say just looking at the past, when it's spiked and it stayed elevated for an amount of time, I would say, I mean, if it's not back down to a somewhat reasonable amount, right? If it's not back to 60, 70 by July, I'd say we're in real trouble.
Well, gas prices, I mean, oil prices tend to elevate during the summer anyway because travel increases. There's a lot more draw. Obviously, energy increases because it's hot outside. There's a lot that happens there, right? That we depend on.
Impact it.
You see what I feel like that there's a lot that impacts it that maybe we're not thinking of, you know, that it's not just that, it's just an indicator. I believe that the gas prices, when I drive by the 18 pylons on my way home with the big digital sign that says gas is $4 a gallon or whatever, there's just more impact to it. It has nothing to do really, it's what it all affects, right?
Yeah.
Because, and never mind Never mind even just basic petroleum products. Everything, I mean, the microphones you and I are talking into right now, right?
Yep.
All centered around petroleum products.
Oh,
So
for
it's
sure.
not just the pump, it's everything,
That's
right?
what I mean. It's everything. So, I mean, I would say it's not really necessarily looking at the gas prices at the pump is not really the best indicator. The best indicator is actually looking at crude oil prices per barrel is a better indicator to look at, and even wholesale oil prices, because wholesale oil is typically moves about 2 weeks before your retail gas that you see at these at like the gas station.
Right, gotcha.
Wholesale is going to move first. So if you can see what wholesale is paying for their gas and track that, that'll give you a better indicator of where we're going. It's going to move before the actual what you're paying for car. And then the crude oil prices is probably even a better indicator, right?
Right.
Yeah.
That's well to pay attention to that because there's different kinds of oil out there. There's
definitely.
yeah. I mean, there's sour, there's blended oil,
Sure.
that kind of thing. So.
Yeah, we're just talking about crude oil. That's it.
Okay. So kind of wrapping back to how it impacts smaller countries. One of the things that you said is that if they have to scale back production, right? Well, that's fine because we can forecast a lower production level. How does the current surplus, if we've got if consumers are feeling the pressure, right? Their dollar doesn't buy as much. That means they're going to buy. That means they're not buying as much, right? Because they're not buying as often and they're not buying as much when they buy. That's going to create a surplus. How does that surplus hurt us? And if so, how?
The surplus of oil?
Well, the surplus of any good or service, right? Due to lack of consumption.
Yeah, I mean, so surpluses are interesting. I mean, because they're typically good for the consumer. Because if there's a surplus of something, it'll be lower prices.
That's the immediate look at it.
That's the immediate,
right?
But then obviously the companies are going to tighten up their supply chains and production to be able to meet actual demand, right? Because the companies, they still have to earn their revenue, right? And keep in mind, businesses forecast revenue, forecast their profit, and then they forecast their cost all into one. So if a business believes it's going to sell an X amount of volume, and that volume is going to spit off an X amount of revenue, then that's how they plan around their costs. And then if the volume isn't there, right, then they have to figure out how are they going to get that revenue. And really, the only way to get that revenue to increase prices. And then ultimately, if they're looking at their profit margin and they don't increase prices, they don't do anything, and volume drops, they don't increase prices, but they need to hit their profit margin, what do they have to do? They have to cut cost. So businesses have different levers that they can use, but ultimately what would happen would be they would cut down on their volume, they would increase prices to make up for that lost volume they're not selling anymore to meet demand.
Okay, gotcha.
Because they need to hit their revenue target, right? And then ultimately what that does is that they need less people in production, right, to from a cost basis, and they lay people off.
How does Wall Street react? And moreover, not just how do they react, how does that start forcing decisions on businesses, both the large corporations and then obviously down to the entrepreneur and small business?
So when you say Wall Street react, you mean reacting to
like the spike in gas prices, the volatility,
like crude oil,
the volatility of it. Because I guess really what I'm driving at, Trevor, is just because there's instability doesn't necessarily mean it's bad. Right, it just means it's volatile. It could go up, it could go down. It's unstable. Because you could have a depression, and that's a stable economy,
well,
right?
Of course. So what's one? What? Yeah, it's stable in the wrong ways.
That's a stable economy.
Yeah,
stability doesn't always equal good. I mean, there's certain situations where you can have a really stable economy. So I don't
think it's a question about stability. I think it's more of a question on certainty. And
fair enough.
So markets don't like uncertainty. That's the whole problem,
right?
And so whenever there's any kind of uncertainty, that's when they'll pull back. And so then when I mean pull back, I mean it just allocated, the dollars are allocated elsewhere. They go to more safe haven assets. They go to safety, right? Dollars fly to safety, right? And that sort of stuff.
I mean, other than
so how does Wall Street react? I mean, Wall Street, they're going to ultimately, if there's uncertainty around how long this conflict is going to go on, if there's uncertainty about how long crude oil prices are going to stay elevated, then that's when sell-offs happen.
Is there any opportunity to capitalize on the moment?
Absolutely.
That's really kind of what I'm asking.
There's a huge opportunity.
Is there a way to win here?
Huge. Yes.
Okay. So
there's a huge opportunity.
How does Wall Street win in the middle of this?
So the one thing to keep in mind about Wall Street is Wall Street wins on the ups and the downs. Wall Street's always winning. Typically, like the way that they hedge and that sort of thing, they're making money on the upside. They're making money on the downside. What you can do as an individual small investor yourself, what you can do is take a look at your time horizon. Number one, look at your liquidity needs. Number two, based on that time horizon, and put the proper hedges in place for yourself to where you've got non-correlated assets. And what I mean by that is the markets go down, that's fine. You have another asset elsewhere that is not being affected by that, that if you need the liquidity, you can pull from. Now, the other great thing is if you do have a long time horizon, now can be one of the best times to actually get in, just in general, right? Because there's been so many good opportunities since the markets have kind of, done its correction right now. And who knows what it's going to do from here. But there is a significant opportunity, right now that we have. And ultimately, if you're somebody who is going to need the dollars, today, I hope that you have the proper hedges in place, because otherwise having to sell portfolios when they're down is not at all ideal.
So here's my question, right? At some point in time, this thing's going to be over.
Yep.
There's no real indicator because there's not enough of a resistance against the opposing force, right? There's not enough resistance from the opposing force to drag this out for very long.
No, of course.
So at some point, there's let's batten down the hatches and weather the storm in some kind of way.
But here's the concerning thing: it doesn't have to go on forever to have huge ramifications a year from now or 2 years from now. It doesn't have to go on. I mean, it doesn't have to go on forever. It just has to go on past a breaking point where all of a sudden, like I said, consumer purchasing power goes down, prices have to go up because the cost of transportation, the cost of manufacturing, the cost of virtually everything goes up due to that. Both production, both transportation, logistics, all that sort of stuff goes up. And so people can't afford to buy those amount of goods that they were used to buying before. So they scale back or they reshift what they actually buy, right? And then those companies have to ultimately retool their plans around revenue, profit, cost, all those things. And when that happens, that's when you see the layoffs. That's when you see recessions start happening. That's when you start seeing markets go down. Even, if this thing lasted, I don't know, however, let's say
year.
If it lasted a year, then
right.
I mean, a recession following would be probably an extremely high probability.
So is there anybody winning right now? Is there anybody that threw a party when this happened?
Oh, I mean, for sure. I mean, because whenever there's any kind of global catastrophe, there's always going to be people that, can capitalize on that sort of stuff, unfortunately. So whether it's good or bad, I mean, there's people that are definitely happy about these sort of things. And so, like I said, just as an individual person, right, what you can do with your everyday life to really try to capitalize is, like I said, markets are down, try to shore up some dollars and, invest them if you can, right? And hold them, long term probably, right? Be a good idea. And then just try to protect yourself in the future now that you see what can happen from actually having to access those dollars during a really inopportune time. Because you never know, right? We bombed Iran, overnight? What was like a Sunday night maybe or something like that? I mean, we bombed overnight and then the next day it was like, oh shoot, portfolios are going down, everything's going crazy, oil's spiking, all these things. I mean, these things happen really quick. Like you don't have time. You got to have things in place before you want to be proactive, not reactive.
So, obviously the people that might win off of this, I'm not going to ask you to speculate on who might win because therein lies the conspiracy theory, right? The ones that are I think the Illuminati profits over every global catastrophe.
I mean, I think,
right?
Well, I mean, I think like, kind of talk about, in the world of finance, I think it's a lot of the people that thought that even, let's say, markets were overvalued and let's say had, huge short positions are loving this because they're saying, oh, I knew it. Markets were too high. It needed a correction. So they've got short positions. So they're betting that it's going to go down. And when it goes down, they're loving that, right? The long positions, the people that are thinking it's going to go higher, obviously are suffering, right? So you've got one side that's cheering it on. You've got the other side that's like, hey, can we wrap this up?
Right.
Right. And then obviously, I'm sure they're hedging against that as well. So you're going to have those people. You're going to have those institutions. It just is what it is. Like I said, because markets are a moving target constantly.
Let me throw you a curveball.
Sure.
This is not anywhere. So, I mean, this is something that literally just popped into my head.
Okay, good.
The city of New York went through an election series where they elected the current mayor of the city, and he had a lot of really big plans. And as everybody knew, those plans had a price tag on them because you're not going to do that.
As all do.
Yeah, everything's got a price tag on it. There's no getting away from that. I don't care what kind of government or economy that you have. Everything's got a price tag, right?
Sure.
His response, right, was basically to raise property taxes. Obviously, he's going after the rich. He's been very vocal about this. How does this help or hurt him if it doesn't, from a taxation standpoint on property and things like and things like that, where he's wanting to tax those people? Obviously, there's a mass exodus from big business that's trying to leave it. Wall Street has basically done all but packed its bags.
So think about it this way. I mean, it impacts
Does
the
this
entire country.
Accelerate the exposure of him being right or the exposure of him being really wrong? I mean, I know what everybody knows our opinion here, right? Well, so just kind of speak to it from a very neutral kind of.
Yeah, for sure. I mean, ultimately, I think, well, it's a very nuanced conversation, but we can let's just talk about like what it does with property taxes and that sort of stuff like that, right?
Right.
So we've already seen it. Housing prices are at some of their lowest points they've been in a few years now, that sort of thing. Though that impacts property, like that impacts the amount of taxes that local governments bring in, right, every single year, right? Because home values have decreased, so the taxes have also come down,
right?
So that has its own kind
of
revenue
chain disruption, right there.
Of course, yeah. There you go. There's a disruption. Right. So the impact of oil and that sort of stuff is just going to further exacerbate it, especially if it's drawn out longer, especially if it ever pushes us into an actual recession, right, where people can't afford their homes anymore, they foreclose, right? Banks are stressed. It's a whole chain reaction, right? And I mean, is it going to prove him right or wrong? I think time is going to tell, but raising taxes on properties that are going down in value right now currently, and potentially we could be really stressed as far as a consumer is in the next few months or year. It seems like kind of like a recipe for disaster, but I mean, I think we're going to find out.
Would socialism insulate us from some of this that we're feeling right now?
I mean, no, I don't think so. I don't think so. I mean, because there's socialist nations that are going to be hit.
I mean, don't get me wrong. I'll continue to pay another dollar a gallon if it continues to guarantee my freedom, so to speak, and my ability to earn.
I think regardless of however your government is set up, I think everybody's gonna feel it. There's just no way of getting around it.
There's just no way. Okay.
Yeah.
So
there's going to be ramifications, and it's really wild when you kind of go down the rabbit hole and you kind of see the full picture of how everything is actually all impacted, and then there's things that are going to be impacted that people didn't even realize that it would until they look back and say, oh, okay, wow.
So as it may impact future plans of corporations and even small businesses, such as take expansion, for example, this may slow that, right?
Oh, yeah. I mean, it definitely could.
I mean, sure. It probably will at some level, could slow those things down as it begins to have that impact. Where are some places that we could look, short of Googling some sort of Google search or whatever? What are the things that we're looking for that would lend us to go, okay, this company is not really worried about it, or this company has canceled all production, it shut down lines in Taiwan,
sure.
That kind of.
Yeah. I mean, there's
where do you find out that information?
So it's really interesting. So if you're dealing with a public company versus a private company, there's different things. So public companies are required to disclose certain things with the SEC and 10K filings and that sort of stuff. So you can find actual filings on their finance, what they're doing with their dollars, all that sort of stuff. So it's a lot easier to track public companies. Private companies it's a little bit harder, right? Because there's no need to disclose those sort of things. So those are where you're gonna have to go to more regional, local places, maybe a county clerk's office, right, to find different different filings or maybe land grants or whatever that's going on, right? But those are gonna be more tough. The bigger companies, the publicly traded companies, they're typically easier, and you can find that stuff on, they'll have They'll have PR statements, obviously, about certain things that they're doing. You'll have extra media scrutiny, too. You actually have a lot more people that are digging into what these public companies are doing. So you don't have to do all the research yourself. There's other people out there that are doing it for you that you can find. Now it comes down to actually looking at it and interpreting it and trying to see, okay, what is this company going, like, what does Amazon think, in the next year or two, right? Are they bumping up CapEx or not? We've seen Nvidia bumping up a huge amount of CapEx, all these different tech companies, right, that are pouring mass amounts of dollars into AI and data centers and expanding on that front, right? So they obviously see it's going to be a big deal, right? So that's where, on the flip side, if you see companies that are starting to sell off, land and, or they're moving warehouses or whatever they're doing, right? You see the expenditure go down, then they're obviously looking to, say, okay, we need to tighten things up a little bit, right? Like we need to get things back on track and then form a new baseline, and then maybe we'll start expanding.
Okay, so I mean, it's like so it's kind of like let's back up 10 and punt.
Yeah, basically,
it's kind of what the idea is. We'll go out, we'll play a little bit of defense, and then until it's appropriate for us to come out and play offense again.
Yeah, exactly. And then you think about like how businesses are kind of ran. It's like how layoffs and all these things happen because they're always retooling the plan every single year, their revenue plan and forecast and that sort of thing, right? And so if they plan a certain amount of dollars in revenue and profit dollars, and so they got to plan volume, then they plan revenue, and then from that comes their cost, and then from their cost comes their profit, right? So a company might have a really great year and still have a bunch of layoffs. People are like, well, how does that happen? Well, it's because they're forecasting the next year to not be so great, right? Or there could be a disruption in the way that they do business where they don't need all these extra people because they found a more efficient way to still deliver the same value to the customer base. And maybe they are even expanding their volume, right? But the different way that they're producing might change. So that's always something I always like to mention too to folks is like you can have a company have an amazing year and still have layoffs because their next year might be forecasted differently. They might have, found a different way to actually deliver the value in a much more cost efficient way, especially with AI nowadays, right? Doing that sort of stuff. So that's just something to always keep in mind. Well, because mass layoffs don't always mean the company's folding.
I think you bring up a really excellent point. Yeah, just because they're laying off doesn't necessarily mean
it doesn't mean
it means a pivot in direction, right? I mean, and it doesn't necessarily
pivot
mean
direction, expectations, right? So it just comes down to expectations, right? Are they planning on growing the next year, or are they planning on receding the next year? Very rare do you ever see it ever, especially a publicly traded company, ever forecast to be flat. It's pretty rare. Like usually there's going to be either up or it's going to be down or whatever.
Right,
That's usually kind of where it is. It's pretty rare to see it be forecasted flat.
Yeah, so, homeostasis and Wall Street aren't the same thing.
No,
at all.
It's not. No, but as a private institution, it doesn't matter. However you want to forecast or what your goals are to expand and that sort of thing. So in a lot of ways, private companies can be easier to kind of run in a way that they don't have the constant pressure of needing to constantly expand and do more and more and more, right? Where public companies do. And that's where you see like the cost stress really hit those in ways that sometimes private companies just absorb.
That's really interesting, kind of the way that you have seen where you see, because they don't have anybody to answer to, you know what I'm saying?
Right.
Because it's interesting that you say the word private companies would absorb it, because their concern is their consumers or their customers or whatever. That's their primary
staying in
concern.
Business and growing at a decent clip of however much they want to grow the business, right? And
whereas publicly traded is a more two-handed concern. One, obviously, they want to be able to provide their goods and services to people that want to purchase them, right? That's sort of frontline stuff. But on the back end, they're responsible to
shareholder interest and that sort of thing.
Shareholder interest, right? Yeah, and doing what's good for them to increase profitability of the company.
Yeah, of course. Yeah. Because the ownership is not tied, privately, it's tied publicly, and there's many different ownerships and that sort of thing. So you've got a lot more obligation in that front. So when you're looking at like what oil can do, it can be extremely, extremely disruptive. And it really depends on how long this goes on. The longer it goes on, the more at risk.
Right.
That's it. And like I said, it doesn't have to go on for a year to have a year's worth of a recession. It could go on for 6 months, and then all of a sudden you start seeing.
What are some things that would keep us from digging out of it, right? That would cause the recession of it all to be protracted.
I mean, I would say number one is the conflict ongoing, right? Constant
Sure.
conflict, not having any stability over there, right? A lot of uncertainty about the Strait of Hormuz and that entire region, right? The uncertainty piece in the region is really what would probably keep this thing going on, for a long period of time, because the uncertainty is the problem. If it came out there's a peace deal and then the peace deal is actually good, right? And it's actually holding up, then you would start seeing things start level down. They'd start cooling off, and then people would start, organizations and things like that will start getting a lot more confident to be able to, allocate their capital. Because think about it, before all this happened, a company might have said, okay, we're going to spend this amount of dollars to open this many new facilities or whatever we're going to do. And then all of a sudden this kicked off. And now they're like, well, wait a minute. I don't know if we're going to do that just yet. We're going to hold on to this capital. Just wait and see. So now you're delaying that. Right? You might have already prepared to staff up and hire a bunch of extra people, but now you're putting that on hold. So what does that do? Long term. So thinking about that, it's a moving target right now. So,
and I think it's
hard to navigate.
I think it's interesting to bring up when we start talking about, you bring up the Strait of Hormuz and why it's a choke point and why it's a concern, right? So it's about a 2-mile wide waterway, passable waterway. It's much wider than 2 miles, but it's about a 2-mile passable waterway that runs right up against mountains. Yeah, essentially, that's got caves and tunnels and all kinds of stuff. It is a strategic stronghold, so to speak. That could disrupt anything that's trying to pass through there. Right. So it's not just a matter of why don't we just go in and take it over, because that may not be possible. It could be very difficult to infiltrate.
Yeah, and that's where you're seeing other countries kind of move forward too right now, and kind of talking about, okay, well, we're all going to get this thing and hold it open, right? Because it's literally in the world's best interest to keep the Strait of Hormuz open and flowing, right? And that's why you're seeing these other countries that are like stepping up. They're like, okay,
here's an opinion.
But here's the other thing too, though. Like, our adversaries actually like it that way, because now what? Oil increases. Now they're making that much more money.
What's this doing to Russia and China?
Well, that's what I was going to say. They actually, a part of them actually really likes it, because now they're able to export their oil at a much higher rate now, right? Bring in more revenue, that sort of thing. So like I said, there's people that like this.
But what if they can't get it?
What's that?
Oil.
Like Russia and China?
Yeah.
Well, I mean, keep in mind, like, Russia is a pretty big producer of oil themselves.
Sure.
Right. Mm-hmm. And they buy a lot of oil. China buys a lot of oil from Russia. So I would say, like, and then keep in mind too, like they're cheering it on too, because they know the longer that oil stays elevated, the higher there is for a recession in the U.S. and that sort of stuff. So I mean,
which weakens us
100%
on a lot of ways.
Yeah, it does.
Yeah, sure.
Yeah. So in general, sure, like adversaries are for sure cheering a lot of that on.
Right. Yeah. I mean,
and they don't have to get directly involved. They can just sit back and hope it plays out longer. The longer it plays out, a lot of times is better for them.
Well, and again, not
good for their citizens.
Not necessarily to decide on one side or the other. Yeah, well, they don't care about their citizens.
Right.
That has nothing to do. It's about making the government strong and making sure that they have money, because their citizens, the welfare of their citizens is not job number one. Yeah, right.
No, typically not. No.
You know what I'm saying? So sure. That's kind of what I was curious about. But they're so isolated from the overall allegiance of the world, so to speak. I mean, they're kind of looked at as the evil empire by a lot of people, right? Mm-hmm. Unless they're desperate. So these struggling nations, whether it was Venezuela several months ago, those sorts of things. Even Mexico may depend on certain things. Yeah. These I wouldn't go as far to call them third world countries, but they don't have a whole lot of economy behind them.
No. Their economy is a lot more fragile, and it's a lot more concentrated than you typically see from like your typical first world country. So
let me just kind of ask you this. I just kind of want to close it down with this last little question here. What are some like pocket indicators? And by pocket indicators, what are indicators that I'm carrying around in my pocket, right? That would tell me things are easing, or it's not as bad as the media is saying, because what the actual market is doing does not reflect sort of the headline news that's coming out, that's propaganda. So how do we separate the propaganda from the actual real indicators?
Well, what I would say is, like, if we're looking at any kind of markets and things like that, I mean, I wouldn't be looking at like the equity markets as a good indicator of things are getting much better. I mean, sure, maybe, but I'm probably not one of the things I would be really, really looking at. I would be really looking at like the dollar index, right? How's the dollar performing? Is the dollar is it getting stronger, or is it getting weaker, right?
Yeah, right.
Because a weaker dollar typically means better for assets in general. Asset pricing and that sort of thing goes higher, right? So, and that also just means that more foreign countries are able to buy more U.S. goods because their currencies go a lot further, right? When the dollar is a little bit weaker, so our ability to export actually goes up. Our ability to export goes down a little bit because when the dollar gets stronger, because now their currencies are weaker against it, so they can purchase less. So number one, dollar index is a good one to look at.
Okay, dollar index, right?
Dollar index, and then the other thing right now, because it is so important, is looking at crude oil futures.
Okay.
U.S. crude oil futures.
Just watching that. And,
just
and
in general.
Right. Okay. This
Just
is
in
what
general.
okay. So for the audience, explain to them the difference between the price of oil and the future price of oil. Kind of, when I'm looking at what oil is selling at today, and then you're talking about futures, right?
Yeah, sure. So like when you look at
is that an anticipated number, or is that sort of what we think it's going to be, or is it?
Well, that's actually how barrels of oils are actually priced, is based off of their futures. Is actually how it's actually priced. So that's going to give you a really good indicator. Typically, oil around 40 to 50-ish is usually kind of like good. Like that's where
and we're what at 110, 115 now?
Yeah, something like that. Yeah, so definitely not where I want to be. So just monitoring that, it would be critical, because that's going to tell you about the velocity at which the global economy is going to run at. The higher the oil, the slower it is.
Oh, okay.
Right. So, and then it can't be too low either, though, because that can also have its own problems.
Right.
But if it's right in that 40 to 50, area, it usually means the global economy is relatively stable from that standpoint, and it's moving at a good clip where it should be.
So can we expect the ripples to work in reverse? So let me unpack that.
Yeah.
Clearly, Strait of Hormuz, gas prices spike, grocery prices go up. Obviously, everything else begins to rise, and it moves us into, a state of inflation. Does it work the same way in reverse? Are we going to see gas prices come down, and then we start watching consumer price indexes come down, that sort of thing?
It can, but it typically is a lot more of it's a bigger lag than, like, the prices will jump, and
faster than they'll fall.
Yeah, absolutely. The price will jump faster than they'll fall. Right. They do. That's just the way it is, right? And because it's the fear is what drives the price increases, and the results and the long-term certainty that's unfolding is what allows things to kind of really cool off. And that takes a lot more time than the fear does, because the fear is all anticipation. It's worst case. Okay, I need to get out ahead of this just in case this happens, right? And then once things get to a good, stable position, that's when it's like, okay, cool, now we can, readjust.
So let me ask this. Is there anything that is like susceptible, obviously, to the price increase, because everything is susceptible to the price increase?
Yeah.
Is there stuff that we'll likely see not come down because, like, the industry figures out that the market could sustain it? They didn't see a real drop off in usage, right? Or like they didn't see a real drop off, but their prices went up because their costs went up. But now their costs come down, but their prices remain the same.
That happens all the time. It happens all the time. It's very rare that prices come down once they kind of go up. In a lot of cases,
the flaw and trickle down, right?
Yeah, well, in a lot of ways, because that's the whole problem. Really, when prices start coming down, is when consumers start going to a different product, maybe a different brand, and that brand starts seeing it's bleeding so much, and it starts bleeding its market share and that sort of thing. And so what they do to bring back market share, they reduce price, they do promotions, they do all these things to help bring people back. So they're going to a lot of organizations will price, and see how long it can hold before they actually start seeing consumers move. And once enough consumers start moving, market share drops, volume drops, market share drops. And then they have to start moving the price down to bring in people, more people, to drive volume, because you need volume.
Right. So watching the dollar, watching those things.
Watching the dollar, number one.
And watching the oil futures.
And watching oil futures are the two number one indicators you can watch right now.
Okay.
That'll give you a good idea. So like when the dollar is at 100 or above on the index, it means it's strong. When it's less than 100, then obviously it's
Where are we
It's
sitting
a little
right
bit
now?
weaker. I believe we were over 100 last time I looked.
Oh, okay. So the dollar's staying strong in the middle of all of this.
because
actually.
and the dollar's getting strong because of oil is staying elevated and it's spiking so much.
Oh, okay. So the dollar, is that because of our amount that we produce, and how much of it do we control? So maybe you could also, you said it was a globally priced commodity,
Sure.
right? And I just want to get this last little explainer thing in there before we close, right? OPEC is a thing.
Yeah.
And so OPEC, I know you and I have discussed this off camera.
Yeah.
OPEC there's a word for what OPEC is.
Sure.
Why don't you go ahead and share with us what that word is?
OPEC, and it's not a secret, right? I mean, they're an oil cartel. Right?
They're a cartel.
They're
right.
a cartel,
Yeah.
right? When it comes to oil production and oil, supply and all that sort of stuff. And ultimately, what they're doing is they're trying to constrict supply to be able to get a certain price, right?
Are they mitigating for weaker companies at all? Or not companies, I'm sorry. Are they mitigating for weaker countries?
They might to try to buy allegiance, right, to smaller countries. Maybe they'll say, okay, here's some oil, right, at a discounted price, maybe to try to get allegiance that way. Could be. But what I would say is oil is globally priced, right? But what is the global reserve currency? It's a dollar.
Right.
So that's what I'm saying.
Right.
Is it you want to watch dollar
because that
strength or
affects
weakness?
everything. It's not just us at home. It's like everybody's looking at the dollar.
Exactly.
Is what you're telling me.
Yeah, exactly.
Okay.
So looking at the dollar, if it's strong or it's weak, some people think that a strong dollar means, that's good. We want a strong dollar and all that sort of stuff. But in reality, a strong dollar actually has a lot of really bad, puts a lot of bad pressure on our economy as a whole.
Okay.
Like I said. So, and then
because their dollars don't buy as much of our stuff, and that's problematic.
Yeah, exactly. Yeah, 100%. And so the other thing too is like we don't want our dollar to be extremely weak either. But we also don't want it super strong. So there's typically like a happy medium.
So it's I mean, what? That's interesting that I did not think about that. Everybody looks at the dollar being super strong and thinks, well, everything's fine.
Yeah,
well,
they get a strong dollar, they think it's good.
No, you need it accessible.
You need it accessible, but not to the point where it's,
dirt.
Yeah, exactly.
Right.
Yeah, there's a happy medium there that you need
the balance, the tightrope that this is
a tightrope.
Crazy.
It's a tightrope. Yeah.
Man. Well, guys, that is the rock and the ripple.